Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to find out, are you guilty of these bad money habits? So pay attention to these everyday mistakes that may put your financial future at risk. Do you keep telling yourself, I'll just figure it out later? Do you constantly make little purchases telling yourself they don't really count? These are just a few examples of common and risky behaviors that can damage your overall financial health. Nearly everyone has bad habits when it comes to their money, but the key to managing your money appropriately lies in preventing them from seriously damaging your long-term financial security. Here are a few behaviors you may not realize can hurt you in the long run, and a few solutions to help keep you on the path towards financial security. Blissful ignorance. You may know the old adage, ignorance is bliss, but ignoring your bills and not understanding your finances can quickly lead you down a financial hole from which it will be hard to dig yourself out of. Imagine the blissful feeling that comes from financial independence and security. The first step in getting serious about your finances is taking account of how much money you have coming in, then understanding how you're spending it. Using personal finance apps can actually help give you a way to figure out the full picture by showing all of your accounts in one place. Once you understand how you're spending money and how you should save, you can use the personal finance apps to set a budget that fits your lifestyle. Stay in the know by using app notifications to get updates when your bills are due and when you're getting close to your budget each month. And don't forget to open your monthly 401k or retirement account statements. Do you know how you're invested? Do you know how much should be invested? Do you know how much you need to invest each month to reach your goal? Do you know your risk tolerance? These are just a few of the questions you should be asking yourself and have answers to. If you don't have the answers to these questions, get them. And if you don't know how to get them, ask for help. So remember, ignorance isn't bliss, it's expensive. Procrastination. Are you someone who prides yourself on living in the moment? Do you tell yourself that you'll start building your savings after your next raise or when you get that new job? Your financial future is just as important as, if not more important than, your current financial situation, which is why it's so important to stash away money for savings. Even if you could only afford $20 each month, you have to start somewhere. As a rule of thumb, try to follow the 25-50-25 rule. This is the proportional guideline that can help keep your spending in alignment with your savings goal. This simply means you should dedicate 25% of your salary towards saving and investing. Then you should set aside no more than half of your income for the absolute necessities in your life, such as housing, food, transportation, and the remaining 25% for expenses that enhance your lifestyle but aren't necessarily essential items. These personal lifestyle expenses include things such as shopping, happy hour with friends, trips, etc. You can start following the 25-50-25 rule at any time. So seize the day and start now. The treat yourself mentality. Splurges are manageable every once in a while. For example, on birthdays and holidays, but they're called splurges for a reason. But the extravagant purchase is more than what you would usually spend or afford. So keep these purchases in check. Remember that frequently celebrating little wins and treating yourself to small gifts will add up quickly. Try to limit the amount of treat yourself moments and reframe the way you think about celebrating. Rather than rushing to the shops or spa, consider meeting up with friends for an outdoor activity or workout class. Just as small splurges can add up, so can saving a few dollars here and there. Keep your long-term goals and financial security in mind while you're celebrating. You'll truly thank yourself later. Now we have information overload. And apologies, we had a little technical difficulty. So information overload. Do you love subscription services and staying in the know about your favorite brands through company newsletters? Having these offers and flash sales in your inbox every day can easily lead you to spend money on items you don't really need. Retailers and coupon services regularly sending out special discounts can tempt you to buy those pricey leggings with one click because they're now 15% off. But do you really, really need another pair of leggings? Were you even thinking about them before you saw the email? Pull the plug on services and subscriptions you don't use and unsubscribe to newsletters that may tempt you to make impulse purchases. The next area is keeping up with the Joneses. We talk about this. In today's social media landscape, it's hard not to suffer from FOMO, the fear of missing out. But that's no excuse to book a lavish vacation that you can't afford on your credit card just because you want to post pictures on Instagram. Remember the long game. Your credit history, credit score, and debt-to-income ratio are important factors that are reviewed when you need to open up a new credit card, make a big purchase such as a home or a car, or take out a personal loan. This means that lenders and creditors pay attention to how much you spend on your credit card, including the percentage you pay off each month and whether you're spending within your means. Hurting yourself by trying to keep up with the Joneses could significantly damage your future financial security. Keep this in mind the next time you think you can just put something on a credit card and figure it out later. And for my business owners, commingling your business and personal finances. Most business owners know to keep their business assets separate from their personal assets. However, there are many small business owners that do not. This is a bad idea, both legally and logistically. If you have paid the money to an attorney or to the government to set up a business entity, whether an LLC or a corporation, the last thing most people want to do is to deal with administrative problems and difficulties like separating bank accounts and assets. However, this is a very important step to keep limited liability of your company intact. In law, there is a business concept called corporate veil, meaning the liability shield between the business owner and the business. When you commingle your business and personal funds, creditors can actually pierce the corporate veil and get into your personal assets through liability through your business. This is the main reason to avoid commingling your funds, although there are also tax reasons as well. Let's discuss the legal reasons to not commingle your business and personal funds and the ways to avoid commingling. Now, remember, I'm not an attorney and not giving you advice. I'm just giving you things to think about so that you can go seek a professional expert in this area. So how do you commingle and what is commingling? When you commingle your funds, you're treating your business funds as your personal money, whether buying or selling. Some of the most common ways to commingle are transferring funds between business and personal accounts without documentation, writing business checks for personal reasons, personal expenses, and vice versa, having only one bank account for personal and business needs, depositing business checks into your personal account, withdrawing money from your business account to pay personal expenses without documentation. It is very important to keep your corporate veil intact. As discussed above, when you commingle, your corporate veil can be pierced. Essentially, all the work that you did when forming the LLC and corporation, such as filing articles of incorporation, paying attorney or filing fees, and perhaps drafting the operating agreement, will be for nothing as far as limiting liability. Creditors can reach your personal assets if you commingle, and therein lies the problem with commingling. So how to avoid commingling? First of all, the impulse to put your business check in your personal checking account is understandable for a small business owner. After all, you want to pay yourself and buy more supplies for the business to grow more. However, there are reasons why you need to deposit the check into your business account first and then pay yourself, and also buy business supplies out of your business account, not your personal account. The first thing you should do is create a separate bank account if you've not already, and document all expenses, withdrawals, and deposits. Documenting allows you to become a better bookkeeper for your business and or keep better records for taxes. Having better accounting by keeping separate bank accounts and only using business funds for business expenses can help you tremendously. And this will help you see how your business is performing and seeing where you need to improve. It also allows you to keep your personal funds separate and helps create a personal budget, since you will not be seeing your business funds in your bank account along with your personal funds. Another reason to do this is reducing taxation. One last benefit we will talk about today is the benefit to your taxes. And it's also a lot easier on your CPA. One big benefit is that the IRS does not allow you to deduct business expenses that you cannot document. When you have one business account for personal and business expenses, it is hard to explain to the IRS what you need to deduct for what and for what purpose. The IRS is a lover of documentation. And by keeping track of your business income and expenses in its own business account, this is crucial to help minimize taxation and maximize your deductions. Many, if not most, small business owners pay more in taxes than they are actually required to because they don't have an organized system of keeping records and recording expenses. By simply creating a separate business account and avoid commingling funds by using business money for personal expenses, you can create a more organized and efficient way to reduce liability and taxes at the same time. So how and why to keep your personal and business funds and finances separate? As a small business owner, every purchase you make is an opportunity to mix your personal and business finances. Some owners would rather not do this, but feel as though they have to. Others might not give it much thought or not know why it could be important to keep things separate. You gain several short and long-term benefits when you organize your business finances and your personal books separately, and it's worth understanding those benefits. So let's take a look at those now. So first, your business entity requirements. Some business entities require you to keep everything separate. For example, if you have a small business corporation, you have to stay on top of the business accounting and avoid mixing it up with your personal finance habits. You don't have the same requirement as a sole proprietorship, but you can still choose to follow the same rules, which I actually highly recommend. This approach is particularly useful if you plan on changing your business entity in the future after a growth period or a similar change in circumstances. This will make that transition so much easier. The second is audit defense. You have a lot of deductions as a business owner and a lot of tax credits you can leverage as a small business owner, but it's possible to attract unwanted attention from the IRS in the form of an audit. One of the most common red flags for small business owners is claiming home office deductions. If you claim these deductions, the IRS just might take a closer look at your tax records and perform an audit. Again, this doesn't have to be a bad thing. When you have well-documented division between your personal and business activities and finances, you can rest easier, knowing that you're protecting yourself from potential penalties. If you're relatively new to filing taxes for your small business, please get assistance from a CPA or another tax professional so you avoid errors. Any cost in bringing in a tax expert for these reasons is well worth it, because if you're ever audited and you don't have a paper trail, documentation trail, or an audit trail, as we call it, then you're going to probably pay more in penalties and taxes than if you just paid someone a little bit up front to avoid all the headache. And it's not necessarily, you can be audited just by bad luck of the draw. You drew the short straw that year. But if you're well documented, it should be a very, very smooth process. I had to go through an audit once really early in my career just because I drew the short straw. And when I went through the audit, I was lucky. I did have documentation for everything. And come to find out, they actually owed me money. So it doesn't always mean they're trying to figure out if you did something wrong. As long as you can prove everything and show documentation, it should be a fairly not pleasant experience, but a fairly easy experience to get through. So this is something to make sure you're really putting into place. As soon as you can afford to do so, please hire a tax expert to help you with this. Number 3, greater ease in accounting or of accounting. Trying to sort out receipts, income, expenses, and assets after they get mixed up takes a lot of time and energy. You have to worry about these every quarter when it's time to pay business taxes, as well as when you want to get an idea of your revenue and expenses. You or your accountant has a much easier time when you maintain a strong separation from the start. If you need to look up information on your company income for a particular month, you have access to this information within a few minutes, and the tax filing process is streamlined and you get better visibility into the cash flow. And yes, initially it may be a pain to set up, but well worth it. And if you're not using an accounting software for bookkeeping purposes, please start that process. And again, use a bookkeeper when you can afford to do so. You will probably pay them a lot less than the amount of time you're spending doing your own bookkeeping. Number 4 is looking at credit score impact. Your personal and business credit can have major impacts on each other. Some small business owners leverage their strong personal FICO score as a way of financing operations or covering expenses. Using your personal credit is one way to open lines of credit without having any commercial accounts established, but you would be personally responsible for that debt, even though it's for your business. If you take out a lot of personal credit cards and loans for your small business and you run into financial trouble, you may have to deal with the consequences to your personal credit score. For example, with every additional loan, you'll have another hard pull on your credit, and those add up. Your FICO score takes a hit, which can affect your housing situation, insurance rates, and ability to get more credit in the future. A common approach some business owners take is to use a personal guarantee on the first few business lines of credit. Once you've established your credit worthiness as a business, then you can focus solely on building up your financing options through your company itself. Separating your personal and business finances. Now that you know how important it is to keep your personal and business money matters divided, it's time to put systems in place to make it easy. Here are 5 things you can do to improve your accounting practices. Number 1, get a business bank account. When you have company funds flowing through a dedicated bank account, you limit the chances that you end up mixing these things up. Your financial institution may also have business credit products available to you as well. This is a really important thing to do at the get-go. And my recommendation too is to have a business checking and savings, or 2 checking accounts. That way you have the inflow for your basic business needs, but then you have a second separate account where you can stash away money that you're going to need for taxes later on without getting behind. Number 2, stick to a plan. Be vigilant about using business funds solely for business expenses and vice versa. You can look at statements to discover where your money goes without playing guessing games about whether it's a personal or business expense. Receipt tracking software and similar applications can actually scan your receipts as you make purchase and categorize them for you. Number 3, understand what you're signing up for. Many business credit accounts require personal guarantees. Make sure you know what your personal liabilities will be and make an informed decision about the amount of risk you're willing to bear. The status of your credit, your personal credit, or financial situation will be an important factor here. Number 4, establish a regular salary. You don't run the risk of dipping into company funds to cover personal expenses if you have a regular salary coming to you from the business. And number 5, keep detailed records. Document the business use of your personal assets as well. You may have assets that you need to use for personal and business purposes, such as a vehicle. Write down exactly how much you're using it, and when you need these records for accounting, you'll have it for those purposes and decide whether or not to take the deduction. But if you don't track it as you go, especially with your vehicle, it's very difficult to do the look back approach, and usually not very efficient and not very accurate. Number 6, I talk about this almost every time I talk about my business owners. Update your financials. We've spoken about this again in prior episodes. For your business, have an updated profit and loss statement and balance sheet. For personal, have an updated spending plan and net worth statement. Just a little note here to remember though, when it comes to investing, your primary residence is not considered a part of your net worth. However, you would want to include this in your net worth for personal reasons. And what I mean by this is when you're looking to qualify to invest in certain things, they ask for your net worth on the application. On the application, it also says excluding your primary residence. I point this out because for some people, their primary residence to them is their main investment. And this could be a very dangerous thing to have as your main investment when it comes to meeting and achieving your investing and retirement goals. These documents should be updated on a regular basis and be readily available to you when opportunities arise. In the past, small business owners have largely been at the mercy of big banks when it came to funding and were rated on a single metric, their personal FICO score. Many business owners were actually bootstrapped and may have leveraged their personal credit to achieve their goals, right? So FICO is a powerful tool, but it's not always reflective of your total business health. Traditional lenders' reliance on it can put you in a position of mixing business and personal expenses, even if you'd rather not. Thankfully, new fintech firms are starting to treat small business owners less like individuals and more like businesses. One way they're doing this is by looking at more data points beyond just FICO scores, like bank statements, invoices, transaction histories, for example. This allows them to make more holistic lending and credit decisions. For business owners looking to grow, online fintech firms offer a way out of this, allowing you greater control of your business data and your financial future. Just remember, all the little bad habits can add up to big financial mistakes in the long run. But the opposite is also true. All the little good habits will add up over time and contribute to your financial success and well-being. And don't forget, take advantage of our complimentary consultation to see what strategies are best for your business and your personal finances. So I just want to thank everyone for tuning in to this week's episode. And I will see you all next week on Friday's Focus on Finances. Thanks, everyone.